Hey, good morning and welcome. My name is Matt Price, and Randy Price, unfortunately, playing a little bit of hooky out of town today and tomorrow. But you're stuck with me, it looks like today. But we'll be talking about retirement planning timeline. We think a critical thing to consider as you do approach retirement. We talk a lot about retirement like you're landing an airplane. You don't want the glide slope to be too steep, coming in too late, but at the same time, you don't want to land the plane too early. And so with that kind of as an analogy, we'll talk about what a good glide slope could and what we think should be as you do approach retirement. So a little bit about us. If you are not familiar, Randy, he tries to joke and say he's my older brother. He's actually my father. Family owned and operated the Price Group. We serve as a fiduciary. We think that's the key when you are interviewing different advisors as you are approaching retirement. We think another key is you want to find someone that's a bona fide specialist. Over 80% of our clients are retired, and the other, call it 17, 18% are on the cusp of retirement. So this is really all we do. You know, another poor analogy to make it two in the first two slides. If you have a heart issue, you don't want a doctor that does big toes on Monday, gallbladders on Tuesday, and hearts on Wednesday. You want a guy or a gal that focuses solely on hearts. And we think the same holds true with retirement planning. So we'd also encourage you find someone that really lives in this retirement space, and that's all they do, weeks, nights, and holidays. A little bit about us. Randy's received quite a few awards. I can't keep up with all of them, from Barron's, Forbes, Financial Times. I was humbled earlier this year to be recognized by Forbes as a next generation advisor. We're both CFPs, certified financial planners. Both went to Wharton to get our CIMA designation. We think education is critically important. And if you're not familiar with our weekly Retirement Insider email, we'll make sure to add you, but we try to push out what we think is some timely educational content, at least on a weekly basis, to keep you updated on any and all things as it pertains to retirement planning. A little bit about our firm, Steward Partners. It's based actually on the biblical definition of stewardship. Raymond James is our custodian. So where client assets are held, we do have Pershing and a few others at hand, but most all our clients are on the Raymond James platform. They've been a great partner of ours. Steward Partners have 35 plus offices, I think, across the country. So not some startup type venture. They've been around for 10 plus years, and it's been a great place for us, but more importantly, our clients, since we've been here five and a half years. So today's agenda, we'll take the next, call it 30 to 40 minutes, and we'll try our best to have the trains run on time here, but we'll look at three different segments: retirement planning if you're over 2 years out, retirement planning less than 1 year out, and then planning after retirement. We think there's a few key things to consider in each area, but let's jump in to planning if you're 2 to 5 years out from retirement. Here's I'd call it a summary slide of what we think are the key points if you are in that time frame, 2 to 5 years out. The old adage, look before you leap. We think it's critically important to create an overall wealth plan. We'll talk more about what our family index number is, evaluating contributions. Had a conversation this morning with a client on, he has 2-3 years left until he actually retires. Do pre-tax 401k contributions or Roth 401k contributions make a difference? And it's very dependent upon your age and really your overall plan, but that's a key consideration as you are landing the plane. And what is a negative year in the stock market? What does that mean to you? You know, in the past, if you are 2 to 5 years out from retirement and the market's down, you kind of say, well, it doesn't affect me. But having a big market downturn could push you out, retiring a year later in some cases. And so how we are allocated is becoming more and more important as you do get closer to retirement. And we think it's prudent advice to consider talking to someone at a minimum. Hiring someone would be our preference who does specialize in retirement planning as you are on the cusp of retirement. So the subject here is your spreadsheet adequate for retirement? You probably would be amazed if you've seen how many good spreadsheets we come across. And it's typically the engineers that bring in the real granular spreadsheets, and then they open up their Excel tables and run pivots on, A, B, and C, and we're truly in awe, probably at least once a month on these really good spreadsheets we see from people who come into our office and are kicking the tires. Our counsel is spreadsheets are really good as you're still working, but in retirement, they become woefully inadequate. And that's not just my opinion. I think statistics really do back that up. This is a little bit of a busy chart, but let me draw your attention to the two left boxes here. And you can see these boxes on the left represent the accumulation phase, or when you are still working. And so the top left box, you start with a poor return year, negative 15% in year one. Years 2 through 9, you have a 7% rate of return. And then the last year, 10th year, you have a good year, you're up 29%. You start with $100,000, you see you end with $188,399. Now, let's take the exact same returns, but let's put them in reverse order, okay? That's the box here on the bottom left-hand side. You start with your good return, same returns years 2 through 9, and then you have a bad year in the 10th year. What you see is down to the penny, you have the exact same outcome. And so the takeaway there is whether you get your good returns in your 30s, your 40s, your 50s, even if you reverse those, assuming you get the same returns, you're going to get to the same spot. And so, quite frankly, a spreadsheet can do a lot of good planning around that. However, in the distribution phase or retirement, which are the two boxes here on the right, this is where the order of returns, or some will say the sequence of returns, it becomes a lot more important. So let's take the top right-hand box. You get the poor return in your first year of retirement, and you're starting with that 100,000. You're taking out 10,000 a year, just in this simplistic example, and you get a good return in your last year or your 10th year. You see that you run out of money somewhere between years 9 and 10. However, the box in the bottom right-hand quadrant, you start with a good year, you have your poor year in the 10th year, you started with 100,000, you still have over $52,000 left. So the point is this, unless you're doing what we call a Monte Carlo simulation, where you're taking randomized returns within the your Excel spreadsheet, we think it's inadequate, and that's we actually use spreadsheets when we're planning for retirement, but we want to take it a step further. We want to show people going through retirement at least 1,000 times. And so we're going to create out of those 1,000 trials a probability of success where we're taking in some of the good years where you have good returns up front, but we're also factoring in, hey, what if my first few years of retirement have negative performance? What does that look like? So we think that's critical when you are looking for someone to help you with some of the retirement planning. Another kind of, I'd say, quote that is thematic and how we look at the world is by Mr. Benjamin Graham, who is one of Warren Buffett's mentors. He says, the best way to measure your investing success is not whether you're beating the market, but whether you've put in place a financial plan, a behavioral discipline that are likely to get you where you want to go. And we think that's key. We think retirement planning is a whole lot more than just stocks, bonds, mutual funds. That's obviously critically important, but the cash flow planning and the tax planning, estate planning, insurance, all these things really cohesively marry together to create what we call our Live Well plan, which is what we've termed our just holistic financial planning. So we think retirement, we don't think it's an event. It's not something like a photograph where you take the picture and then you're done. It's an ongoing process. And so I mentioned earlier this Live Well plan. This is not something we create and then we're done, never look at it again. We're looking at our Live Well plan for clients each and every year. And we're tracking our progress. Are we ahead of track? Are we behind track? Are we right on track? And we don't think, unfortunately, if you don't have it written down, we don't think it's a plan. But part of what we're trying to solve for here is how much money can you spend? For some clients, that's how much money can we give? How long do we want our money to last? What rate of return do we need? We'll talk about that on the next slide here. And how do I invest my money? You know, most people come to us and say, hey, I've done my best to put away as many acorns as possible to try to grow it, but this is a sea change here. How do I now not invest money to grow it? I feel like I've done that pretty well over a 2-3 decade period, but now I want to produce income. I want to preserve capital. I want to make sure that we have enough, and if there's something left for my kids, that's great, but that might not be the primary concern. And so that might not be you who I just described, but that is a very common feedback that we do here when we are putting together a Live Well plan for folks who are kicking the tires and approaching retirement. So this family index number, we call it this because we are trying to figure out what rate of return each family needs to be successful in retirement. And we want to do that by taking the least amount of risk possible for that family to be successful. So we want this family index number. It's not necessarily a ceiling on what we earned. It's not a guarantee of what we'll earn, but we want it to be an average over a market cycle. So call it a 10 to a 15-year period. You get some good years in the markets, you get some bad years, you get a few okay years. And when you look up 10 to 15 years later, we want that family index number to be your average rate of return. The old adage, under promise, over perform. We also like to be conservative with this, so we're not looking to whisper in someone's ear and promise them these great returns of what we think we can get. We want this to be an easy hurdle for your overall Live Well plan to tackle. Here's something we added earlier this year, maybe it was late last year with our presentations. We want some real tangible ideas that you can walk away with, not just maybe some more broad thematic ideas that we're talking about with retirement planning. But this would be a tangible idea that you could potentially put in practice. It's an alternative to a Roth IRA. A lot of our clients make too much money to put money directly into a Roth IRA. And so this is also referred to as a backdoor Roth. But here's how it works. You can put money into a traditional IRA, and that maximum, if you're over 50, round numbers about $7,000, and you do not get a deduction for that. So this is what we call a non-deductible IRA. So say you do that on a Monday, you put in $7,000. On Tuesday, you convert that into a Roth. Now, what you would do is you have to pay tax on the gain, but if you just did it from Monday to Tuesday, there's no interest earned, there's no gain in there, there's no taxes owed when you do that conversion. So that's kind of the backdoor way to get money in. Now, there's what we call the pro rata rule, which we see a lot of people stub their toe on. And so if you have any pre-existing IRAs, you have to take a pro rata amount that would be taxable. So said another way, say you had a $7,000 non-deductible IRA that you just made a contribution to, but you had another $7,000 deductible IRA that you've had for 10 years. If you did this conversion, you'd have to have 50% of it be taxable, 7 as a percentage of 14. So it kind of takes away a lot of the, I'd say, value if you have pre-existing IRAs. However, this is something we would encourage you to check with your CPA. We don't provide tax advice, but our understanding is this does not apply to 401ks. So while a lot of people think of 401ks and IRAs kind of the same bucket, they are very similar, but this is one of the salient differences between the two. Having a pre-tax 401k does not preclude you in this pro rata rule. But once again, double check that with your CPA. Second idea, kind of that's tangible, hopefully you can walk away with today, would be a similar idea, but it's inside the 401k. So an alternative to the Roth 401k contribution. So what this means is you have the ability with most all 401ks, and I won't put them all in there because not all of them have these capabilities, but we're seeing more and more plans adopt this year over year. You have the ability to do a pre-tax 401k that's been around forever. Here in the last, call it 10 to 15 years, you've had the introduction of the Roth 401k, which is you're taxed on the money now, but it grows tax-free. And a lot of plans have an after-tax option. So you don't get a deduction off your gross income for an after-tax deduction. But the earnings inside of the after-tax option grow tax-deferred, not tax-free. So what you have the ability to do with a lot of plans is take your contribution to the after-tax piece, and you can actually roll that into your Roth 401k. Most, if you are allowed to do this, most of them allow it once a year. So check with your plan provider, whether it's Voya, Fidelity, whoever holds your 401k, and a lot of plans will allow you to put an after-tax contribution on top of a Roth or a pre-tax contribution. Question just came in. If you have the maximum marginal tax rate today, would a Roth IRA still be a good option? Yeah, great question. For your 401k, it depends on how long you have until you're 73 when you're required a minimum distribution start. It depends on what other sources of income you'll have in retirement. But I would say a general blanket statement would be this. You're probably best to try to reduce your marginal or your taxable income while you're still working. But with that being said, if you're maxing out your pre-tax 401k and you don't have any other IRA assets, you still could qualify to do this backdoor Roth. And so if you're in the highest marginal tax bracket, you're not going to get a deduction for an IRA. So you might as well put it into a Roth. But I'd say, it depends on family to family, but I think that's a pretty decent overview for just kind of a general answer. Okay, so looking here at your risk budget, mentioned this earlier in the summary slide. What would a 25% correction do? Would it delay your retirement? And so the purple line, we're looking at 2000 to the end of 2015. That's the S&P 500, the overall stock market. The green line right above it is 50% of the upside, but also 50% of the downside. And what you can see here is you actually end up ahead by taking 50% of the upside out and 50% of the downside out over this 15-year period. So we're not saying be 50% stocks and 50% cash. What we're trying to just illustrate here is as we get closer to retirement, we want to study your risk budget. A lot of people come to us and say, hey, I'm really conservative. We've met with hundreds and hundreds of people who are on the verge of retirement, and I don't think anyone has come in and said, hey, I'm really risky. Let's roll the dice here. Everyone thinks they're conservative, but at the same time, we'll look at a portfolio, and that portfolio sometimes could be 50% of the company stock and 50% of other stocks, and they consider themselves conservative. So there's a lot of shades of gray when we use the word conservative. Our counsel is, let's look at what stock percentage we think you need to be in retirement and start to move toward that. Maybe not overnight, But if you have 3-4 years until retirement, let's do it gradually. So when you're at retirement, you're more in line with where you want to be. You're taking some of the risk off the table of if there is a pullback prior to retirement. This slide might sound self-serving, so take it for what it is, but consider hiring an advisor. We think that time frame of 2 to 5 years is the right time to do that. This is a study done by JP Morgan every year. It looks like this one we have up here in the slide through the end of 2020. They update this typically every year, every other year. The numbers don't change a whole lot year over year, but the average investor has woefully underperformed, as you can see. But on top of that, advisors typically offer access to alternative investments, individual bonds, strategies for additional income. And we think the big thing is taking the emotions out of investing. Mistakes are a lot more costly as you are in retirement or approaching retirement. You know, I joke and say, if you're 32 and you make a mistake with retirement planning, you're like, I mean, that seems like a lifetime away. But when you're a couple of years out, a couple of months out, a mistake could be drastically more costly to you and your family. So we think that's prudent advice, even if I do have kind of a self-serving interest with that. So let's transition to less than 1 year out. Here's a summary page of what we would recommend, at least some key considerations. Let's really dig in and estimate some of the retirement income needs. What are your expenses? We never like to use the B word, budget, but we think it's more palatable to say cash flow planning. That's a key input that we need for your Live Well plan to see how successful it is or is not. Really roll up your sleeves, look at the pension versus the lump sum, study the company discount rate, what are our interest rate expectations over the coming quarter, over the next few quarters. Are you below 59.5, or are you past that magical age where you can take monies out of your IRA or 401k without a tax? We'll talk about some of the ways, but we've had a handful of folks here just over the past 6 months before 59.5 retire, and there are some kind of creative ways we can get our hands on those pre-tax dollars without the penalty. How are we going to produce income? I mentioned the discount rate, ordinary income, tax rates, capital gains tax rates. It's kind of like shooting a moving target with administration to administration. And then once again, look to hire a team that provides advice if you have not already done so. Income needs in retirement. Inflation really is the hidden tax. And we did just last week or 2 weeks ago a webinar. We hold quarterly webinars that you are more than welcome to attend just on the marketplace as a whole. We talked a lot about inflation on our most recent one. Inflation in retirement is the hidden tax. Randy loves to talk about the bank of mom and dad is always open. So planning for those family trips, planning for those grandkids Santa Claus gifts, planning for, go down the list of what grandparents pay for, what parents pay for. I have 4 kids at home. I can sympathize and empathize with those expenses. Big ticket items, we don't want to just include monthly budget, but replacing the roof, new cars, that trip you've been thinking about, fixed and variable. And then, something that we're passionate about is gifts, whether it's to family or charity. And it makes us really excited when we can talk about charitable giving and do it in a way that helps the family, our clients, from a tax perspective, but also helps charities and kind of causes that are near and dear to their heart. So rule of thumb is you end up spending 70-80% of your final year's salary, but that is a rule of thumb. So we see numbers higher than that. We see numbers lower than that all the time. Thought this was a pretty catchy phrase, is 3%, the new 4%. And a lot of you probably have heard of the 4% rule, but if you haven't, let me explain. you started out in this case with $500,000, and if you took out 4% from your portfolio and got a raise on a regular and consistent basis for inflation, this is on a balanced portfolio, part stocks, part bonds, you end up with a little bit more money than your original basis 21 years in. Even with interest rates moving higher over the past year, interest rates on a historical basis are still relatively low when we look at the 70s, the 80s, the 90s. And so one could still make a compelling argument, hey, 3% is a much better distribution rate than 4% based on where interest rates are. Now, a big piece of that is how old are you when you retire? What type of stocks do you own? So I wouldn't say that's an end-all be-all statement, but it is something worthy of consideration on how much are we taking out of the portfolio. What's worked in the past may or may not work as well in the future, just based on how much income the non-stock piece of your portfolio is producing. So less than 1 year out, really want to look at the company pension versus the lump sum. We've been humbled to help quite a few families from each of the big integrated oil companies plan for and walk through retirement. So we've seen our fair share of these different plans. But a few highlights I'll share with the pension. Income for the rest of your life. We think the big con to the pension is inflation. The rule of 72 is something we talk about. How long does it take your cost of living to double? You take 72 divided by the rate of inflation, and you get that answer. So if you have 3% inflation, 72 divided by 3 is 24. Your cost of living is doubling every 24 years. But what if inflation is 6%? 72 divided by 6 is 12. You could see your cost of living doubling every 12 years. So that's really the downside to the company pension is you can't keep up with inflation. Obviously, the lump sum, you can invest it and hopefully offset a lot of that inflation, more potential inheritance for your next generation. That is a goal, but you can spend through the capital. And so that would be a downside is spending through the capital too quickly with the lump sum. Mentioned earlier, have had, I'd say, more people prior to 59 and a half. Had one client actually before age 50 retire this year. Taking a one-time distribution when you're rolling over the 401k is an option to get some funds out without the 10% penalty. 72T is part of the IRS code section where you can take out systematic and equal payments. There's some nuances built in there. Typically, that only makes sense if you're 55 or younger for a whole host of reasons. But that's a way to get some money out. NUA, net unrealized appreciation. This is peculiar to your company stock. We would say this as a good universal piece of advice. If you have low basis stock in the plan, please talk to a professional before looking to make any changes to that particular piece of your 401k. If you make a change, it's retroactively cannot be undone. So the low basis stock is what's really valuable for an NUA or net unrealized appreciation on if that strategy would make sense or not. Lines of credit, when people do typically retire early, we see a lot of clients get part-time jobs, and that's not, it's more something that they're passionate about. We had one client go work, she had a love for coffee, and she thinks working in a coffee shop, a local coffee shop is just the best thing in the world. And then obviously after-tax assets can help bridge the gap until that 59 and a half magical age. Dividends in retirement. If you've read any of our blogs or our Retirement Insider weekly emails, you probably are well aware we talk about dividends a whole lot. We think they're one of the keys to success in retirement. But here's a look at why we think that. Each bar represents a decade of investment returns, and the royal blue portion represents the percentage of that total return that comes from dividends. And so if we look at the average, about 40% of the total returns dating back to the early 40s comes from dividend income, which is not a rounding error. I mean, it's a material amount of your total return. But more importantly, we typically look at this dividend income of how we meet the cash flow needs for clients in retirement. So some clients will say, you know what, I've owned the S&P 500. It's worked really well. And that's probably been true. Congratulations, the S&P has done really well over the past, call it 15 years. But we think as you're approaching retirement, this is a time to really reconsider, is growth of my money the goal, or is income production the goal? And while the S&P does produce dividends, there are a lot of stocks within the S&P, but we can create portfolios that produce a lot more income than just the overall indexes. So here we say safe, quote unquote, bonds. And last year was a real wake-up call for a lot of investors on bonds. While they've been thought to be safe, quote unquote, they really were not in a 2022. So we think now it's arguably equally, if not more important, to have a bona fide investment strategy for your fixed income when compared to your stocks. And so for us, that looks like owning a lot of individual bonds, CDs, corporate bonds, things of that nature. Looking at some fixed income alternatives for families when that makes sense. Looking at some private credit. So there's a lot of different ways to produce income from the non-stock piece of your portfolio than just doing some normal bond mutual funds. So we think there should be some wind at the back, though, with interest rates. Bring you back to your childhood playground. When interest rates are up, bond prices are down, and vice versa. We don't know if it's the next week, the next month, and the next few months, but we think over the next year or two, you should see interest rates start to move lower, which would be a little bit of a tailwind for bonds when we look back at history. So investing without a process. This is a little bit of a busy slide, but what I want to draw your attention to are the two pieces here in red. This one on the left is the end of 2002. The one on the right here is 2008, early 2009. And what this line represents is the overall market. So what you can see here, and these bluish kind of up and downs, this represents the fund flows of mutual funds and ETFs. So kind of tracking the overall markets. And what you can see is the two biggest selling periods in history, dating back from 96 to, it looks like, the end of 2019. The most sales happen at the market bottoms. And this isn't my opinion, this is just facts. We want to take the emotions out of it. And we think doing that, the way we do that is having a process, knowing what we own and knowing why we own it. And we want to counsel clients to stay away from making poor decisions in emotional times. We think that's one of the values we can provide families, is just being an unbiased third party to take a look at their finances when we know there's going to be rocky times. That's just the way the markets work. But we want to help you in those rocky times, provide some perspective that sometimes is hard to come by when values are down. So why do you need an investment process? I kind of just mentioned it, but income generation, discipline, we want to preserve principal and create the level of income you need after retirement. So now let's look at planning after retirement and a few key pieces to consider. This is what we call stress testing your portfolio. So I would say intuition would tell me, if I didn't look at the slide and help create it, that if we're down 20%, well, we need to be 20% to get back to break even. That's kind of would be my just guess off of the cuff, but what we can see here is that's not necessarily accurate. If your portfolio is down 20% and you're taking out 4% per year and you have inflation of 3%, the yellowish box there of 36% is what you need to get back just to where you started. So in retirement, I think this is key. The shift needs to go from growing capital to preserving capital. You know, the best type of offense is defense, we think, in retirement. And so we can win over the long term by just losing less in these down markets. And so it's a philosophical shift that has to happen for the client, but that's really how we look at the world from an investing standpoint, is we want to win by not losing as much in down markets. Now, I'm not whispering in your ear saying we're never down, and this is not a annuity commercial either. This is, let's create portfolios that can withstand downturns, which is just going to allow us to recover a whole lot better, allow you to have to regain less to get back to where you were when we're taking money out from the portfolio. So this is not a holistic look of some planning ideas after retirement, but these are just a few salient ones that might spark your interest, and very happy to talk about these in more detail on a one-on-one basis. But holding your income producing assets in qualified accounts, qualified meaning IRA, 401k, QCDs or qualified charitable distributions for your required minimum distribution. Required minimum distributions start at 73. You actually can do these qualified charitable gifts directly from the IRA, starting still at 70 and a half. Gifting of appreciated stock. A big thing is, where and when should I take some of these distributions? I have Roth money, I have pre-tax money, I have after-tax money, I have a pension from an old employer. When should I turn that on? And so cohesively marrying these together is really what our Live Well plan attempts to do to provide value for you. Roth conversions, that's an idea. If you're not working anymore post-retirement, but only taking after-tax assets, we think it's a high honor in this country to pay tax at 10 and 12%. You're in that 12% marginal tax bracket up to round numbers $89,000, plus at least the standard deduction on top of that for a married couple. So we'll also talk about, should we withdraw IRA assets before you're required, before the RMDs? And sometimes the answer is yes. And we're looking at that from a holistic perspective. How do we reduce your lifetime tax bill, not necessarily a tax bill in 1 year? And then we think this is key. Planning in retirement should be benchmarked against your goals. So that brings us back, I mentioned it earlier, our family index number. What rate of return do you need in retirement to meet your goals to be quote unquote successful? So we would be happy to create a Live Well plan for you and your family. I think if you do that, you'll find a few things. Number one, we're not selling anything. We serve as a fiduciary, so we're not trying to get you in some product that gives us some big commission. Number two, we have the heart of a teacher. So this is the fun part of our job. We help educate people as to grow closer. And number three, you're not going to find that we're really overly selling you to hire us or not hire us. So Randy, he has the heart of an old Baptist preacher. And our hope is, with that Live Well plan, we provide the 3 C's: comfort, confidence, and clarity about your financial future. So no cost, no obligation to do that. Good way for you to kick the tires, talking to some different advisors. It's a good way for us to also kick the tires to see if we would be a good fit for you. So questions, happy to take those online here. If you have more of a personal question, happy to review that by email, by phone. Here are our email and phone numbers, but this is the Price Group. Randy, myself, Maddie with the red hair, Tiffany and Melissa, and we are passionate about our role of helping families plan for and walk through the complexities of retirement. So we're here if you need us, and thank you for your time today. Take care.